Hi friends, whenever markets fall, quality stocks also correct, giving us bargain opportunities to invest in. So in this video, I'll speak about 5 stocks that I personally plan to buy on dips. In fact, I wrote a detailed note about these buy on dip stocks and giving the rationale behind of these stocks on my YouTube member community just few days back. But in this video, let me give you 2 to 3 minutes of commentary of each of these 5 stocks. So the first stock that is on my list is from pharma sector, a company called Netco Pharma, and have a look at my screen. You will see that from almost February to June time frame, the stock consolidated between 950 to 1100 range. After 1100, the stock gave a good run up of around 50%, hitting all-time high of 1630. And now at the time of recording this video, stock has fallen from 1630 level to almost 1350 level, giving a 17% dip right now. Now, what this 17% correction has done in my view is that it has made valuations look very, very attractive. For example, the PE ratio of this company is at around 14, while the industry PE is at 37. And if you compare this with other peers, you will find that Natco Pharma's PE is really low. If you look at the PB, it is trading at industry level. And if you look at the PEG ratio, it is one of the lowest ratio that we can see in pharma companies, meaning what? That the earning growth of this company is on the higher side, while the price appreciation we see is not very high. In fact, that's a very, very good case to buy in. And that is why the PEG ratio is lower, giving us good earning growth. If you look at the ROC, look at the ROE, all these numbers are looking very, very good in my view. Now the question is that can this stock compound at 20% to 30% of CAGR in the, let's say, next 5 years? Because I'm not a trader, I'm an investor. And if I look at the history of the stock, you will see that in the last 2 years, the sales of this company has doubled. And if you look at the profits, they have gone from 170 crores to almost 1400 crores. So the stock is doing pretty well fundamentally from a historical point of view. Also, in the last 10 years, if you look at the compounded profit growth, that is at 30% CAGR basis. So a company that has produced profit growth of 30% could very well give us 20 to 30% of earnings growth in the next 5 to 10 years. And such stocks, if you buy and hold, you don't need to do much. You just need to hold them. Okay, Rahul, we understand it. What about the future visibility? So I did a detailed post about this particular stock on my YouTube member community. And if I just pull out a couple of the key points from a future earnings perspective, the company is guiding for a growth of 20%. And that, in my view, is a very, very good growth rate. Also, if you look at the cash that the company have on the books, and that is around 2000 crores. And in my view, that's a very, very good cash position this Natco Pharma company holds right now. So I've done a detailed analysis as well. And if you're looking for such detailed analysis, you can become a YouTube member as well. Go to my channel, click on the join button and follow through the process. The feedback has been excellent. I've written more than 500 posts in just last 1 year, giving a lot of insights from the stock market. Now, coming back to my final point on this stock before we move to stock number 2, you will see that right now there are 2 chances here. The stock prices might go up. Stock prices might in fact come down. That is route 1. And when that happens, you don't panic. If you believe in this particular stock, what you do is you again go and accumulate the stocks. This is the investing principle. I want you to understand that buy on dips doesn't mean that when you take a first entry. So for example, if you take a first entry here for an example purposes only, and then the stock falls, you should not panic and just say that, oh, this was a bad entry. No, absolutely not. These stocks you have to accumulate buy on dips because you have some conviction, and you can see that there is going to be around 20%, 18% of growth coming up. So if you hold for 3 to 5 years, then there is likely to be good price appreciation in my view. Do not take this as a stock recommendation. I have tried to give you principles of buy on dips so that you can understand it practically. With that, let's move to stock number 2. Moving on to stock number 2, which is from the power sector, a company called REC Limited. And if I give you 2 minutes commentary of REC Power, first of all, have a look at my screen. You will see that in the second half of 2023, the stock rallied by almost 150%. After that, there was a second move up by around 25% just within the 4 months of time. And the third move up was around 22% in the last 4 months. The stock has now dipped to around 520 levels at the time of recording this video. Now the question is that, Rahul, could this stock compound at a rate of 20%, 25% in the next 3 to 5 years? And my answer is that yes, it has the potential, because if I look at the history, the stock has compounded in the last 5 years at a 20% profit growth. That in my view is a very, very healthy growth rate. Last trailing 12 months, it has been compounding at 25% from an earnings perspective. But more importantly, if I look at the vision of this company's management, company is guiding for a 10 lakh crores of loan book by FY 2030, meaning that right now their loan book is around 5 lakh crores. It is going to double by by FY23, 29, 30, and that is likely to be a growth of around 16% yearly. If I compare that with banks growth rate, typically it is around 12 to 13% right now. So that is a very healthy growth rate. REC is going to beat majority of the banks in my view. Also, if I look at the valuations of this company, very low PE of the stock, 9.43 versus industry PE of 23. PB is also very low, 1.89. The PEG ratio is looking very, very low, 0.48. Again, very, very good ratios to look at from a valuation perspective. In fact, if you're confused between companies like Power Finance Corporation, REC, IRIDA, what I did was I created two videos on my channel. One is dedicated on REC stock. Please go and watch that video. You're going to learn about that company because I've gone deep into the stock, and also I've compared these three stocks at some level. That will also give you very, very good insight. And coming to the risk side of this company, one thing that you need to understand is that this company is giving loans to other companies that are operating, for example, in the wind, thermal, power and solar, etc. So what happens is that they're not limited to one power theme. So for example, if the government policies changes in the short term, let's say for the wind companies or for the solar companies, this company is going to less impacted because they can lend to other renewable energy sources or even the thermal sources, right? So that's a very good thing about this company. The downside is that this is a PSU company. People who don't like Sarkari companies, you might want to avoid this company. But all in all, if I come back to the final point on REC Limited, if you see that right now it is at 520, it might correct further, and in my view 410 is a very strong support because during a 4th June election crash, that was the minimum drawdown that I saw in this stock at around 410. I don't think it's going to go down below that if I'm being very data driven here, if looking at the past data. But of course I can't tell you the price point at which you need to invest or whether you should invest or not, but I've given you some very good analysis just in 2 to 3 minutes of time, giving you details about this company. With that, let's move to stock number 3. So far, if you're liking this video, hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. With that, let's move to stock number 3, which is from the insurance sector. The company name is PB Fintech, which is Policy Bazaar. Have a look at my screen. Very, very interesting chart. You will see that back in November 2021, stock got listed at around 1150 level, and it took almost 2 years for the stock to come back to 1150 level. So it has really tested investors' patience in the last 2 years up until February 2024, and from that time onwards the stock has gone up to 1950 levels, and from that time onwards it has come down by around 13% at right now at around 1700 level. So I'll now speak about why this 2 years of wait period, why this correction, and also the future prospects of this company in the next 2 minutes. See, point number 1 is that the company has been a loss-making company up until March 2023, and that is the precise reason that it took the company almost 2 years to come back to the listed price, which is at 1150 rupees level. But in the last 12 months, if you look at the last 3 to 4 quarters, the company has started to make profits. Now, in fact, trailing 12 months, the profit growth has been around 135%. In March 2024, it generated around 64 crores of profit. This is a very, very similar story to other companies such as Zomato, etc., where the company took almost 8 to 10 years to become profitable. But when the company becomes profitable, investors start to buy the stock because they know that there is going to be future earning potential in the company. Now, if I look at the valuations of PB Fintech, you will see that Rahul, the stock is trading at around 763 PE. But please understand, all of these ratios and data points are showing you the historic fundamentals. The company's ROC is 1.75%, 1.13% from an ROE perspective. And retail investors who are new into the stock investing, they would see this as a red flag saying that the company is not performing well. Why all of a sudden the company's PE at this high level? Please understand, this is all past data, right? Now the question is whether the company is going to grow from here on, because these ratios will become normalized when this company start to produce profits. And on future, although the company does not give any growth guidance, but if you look at what their Yashish Daya, the CEO of the company, is describing, is that every company goes through 3 phases. One is the growth, second is the maturity, followed by the decline. Right now, where PB Fintech is at the early stages of the growth is what their management is saying. And I think I somehow agree to that sentence, because if you look at the health insurance penetration in India right now, 65% of expenditure is paid by people from their own pockets. People do not have insurance yet. And if you compare that with other countries' data, for example, developed countries like UK, US, that is a very, very high penetration of insurance. Here right now in India, the penetration is very, very low when it comes to health insurance. Now, in the next 5 to 10 years of the time, the insurance companies, in my view, are going to do much better because the penetration of insurance in Indian market is going to become high. And therefore, companies like PB Fintech, which are the number 1 insurance policy aggregators are going to benefit from that. Now coming back to the latest 13% of decline that we see in the stock price, mainly because the company announced that they are going to venture into the healthcare segment. They are also going and entering into the hospital sector. That is why all of a sudden investors, they got this news, panic sell, the stock down by 13%. It's now picked up back to normal levels now. But coming back to the final point on PB Fintech, right now the stock is trading at around 17-13 level. Can it go down? Of course it can go down. It might go down to 1600 level. I see a support there. It might go down further to 1400 level. There was a good consolidation at that level. I think these are some good levels to be aware, and the stock is already down by around 13 to 14%. So again, I've given you 2 to 3 minutes of commentary on this stock. Haven't done the deep dive analysis. On everyday basis, I do post on my YouTube member community. If you want to get into details as well, you can become a member. Go to my channel, press on the join button and be my guest. With that, now let's move to stock number 4. Moving on to stock number 4, which is from the wealth management AMC space. And in my view, wealth management space in India is going to do really good in the next 5 to 10 years, because have a look at this data. You will see that number of billionaires we will produce by 2020-27 is going to be 195. Ultra high net worth investors, and if you look at the total wealth opportunity in India by 2027, it is likely to be around 2.5 trillion US dollars. And that's why companies like Geo Finance are entering into the space of wealth management. It is going to be a very good growth sector in my view in the next 5 to 10 years. Of course, there may be short-term pressures and pains because of what happens if the stock market falls or corrects by, let's say, 5%, 10%, 15%. But overall, in the long run, wealth management space in India is going to do much better because of the earning growth potential I see in the Indian companies. So the stock I'm going to cover in the next 2 minutes is Motilal Oswal. This stock has given massive 220% rally in the last 1 year, giving a lot of buy on dip opportunities, as you can see on these circles that I have marked here. Please understand that you cannot buy a stock almost at this level, the price which may be at around 224 level in the case of Motilal Oswal. It's not practically possible for us to do that with every stock that we hold in our portfolio. Yes, few stocks here and there we might be able to accumulate and buy at a very low price, but buy on dip investing approach, you need to be really clear with this approach that the stock gives you a lot of chances when others are fearful, and that's where you go and buy the stock if you are convinced about the long-term growth of the stock. So for example, here these circles have given good buy on dip opportunities. They would have created a lot of panic and these points because the investors will believe that, oh, this stock is falling, now should we go and book the profit, exit it, and etc. and etc. Now point number 2 is that there was a very interesting article about Motilal Oswal becoming a double engine compounding machine, very similar to what Warren Buffett's Berkshire Hathaway has done in US. Interesting article. I definitely will put that in the link right in the pinned comment or in the description. Please go ahead and read this article. I really admire Mr. Ramdev Agrawal, one of the legends that I like to hear. Each and every word is very full of wisdom and practicalities. I really like him. Again, I'm not promoting him as such, but I really like to listen to his commentary generally. Now coming back to the compounding machine that we are talking about here, last 10 years the revenues have compounded at 31% growth rate. Profits have compounded at 42% CAGR. So when a stock or a company, their profit compounds better than revenues, that what does it tell you? It tells you that the company is operationally very good. They are generating more and more profits for the same sales that they are earning, right? This point needs to be really clear in your minds, right? Overall, if you look at the company's valuations, not very highly valued. PE is at 15 versus industry PE of around 16.89. PB is slightly on the higher side right now. PEG ratio is very good in my view. If you look at the ROCE, ROE numbers, sometimes these numbers are also not correct on screener. So for example, ROE here is 32%, but if I go and read their Q1 commentary, the company is reporting 44% ROE. That's a massive 10% difference. So please do verify the data whenever you're looking at tools like screener. It's very important for us to get the data right, because you're making decision based on the data, right? And if the data is incorrect, then your decision is likely to be incorrect, right? Again, very good set of growth you will see here. I'm not going to read it out. Pause the video, absorb these statistics, and you will understand why I really like this Motilal Oswal as a company right now. Final point on Motilal Oswal in terms of the pricing points. Of course, the stock is now trading at around 720 level at the time of recording this video. It might come down further, absolutely possible. It might go up from here. I can see good support levels at 585, 507, 473. Not a stock recommendation for you to consider. But again, I've explained you the rationale of buy on dip opportunities, and you should only take a bet in a falling stock if you're convinced about the future growth of that company. So far, if you're with me, hit the like button. Let me know in the comments a simple thank you. Before we move to stock number 5, which is a company called Zomato Limited. Again, very interesting video that I did between Swiggy versus Zomato, right? Go ahead and watch that video if you want to get into deep data of whether Zomato is bigger, whether Zomato is growing higher than Swiggy's rate. But more importantly, if you look at the chart of Zomato, you will see that in August 2021, the stock got listed at 115 rupees level, and it took almost 2 years for stock to come back to that level. What does it tell you? That if a stock has got potential growth rate coming up, then you really need to show patience with the stock, right? Now, after that, the stock gave 150% of rally. Now, right now trading at around 270, 275 rupees level. I like the stock because of the reason that I explained in the video, which is Swiggy versus Zomato. Of course, until Swiggy get listed, I do not know whether I am going to go with Swiggy or not, because it really depends on at what price it gets listed, what is going to be the price after IPO, and so many other factors that comes with Swiggy. But as of now, I really like Zomato as a stock, right, because of the potential growth in the future. But when it comes to valuation of Zomato, you will again see something very absurd in terms of the PE ratio, PB ratio. But please understand that all these are the historical fundamentals, because the company has been making losses. So if I show you the data, company has been making losses up until March 2023, and only in the last 4 quarters the company has started to generate profits. So all the ratios that you might see are going to be skewed towards the losses the company has been making in the last 8 to 10 years. Please take it with a pinch of salt in terms of the valuations, etc. But I've given you a lot of details between Swiggy versus Zomato video. Go and have a look at that video. Last point I will say on Zomato is that it is likely to show some pressure in the short term, and the stock might come down to between, let's say, I don't know, 240 level, 220 level. In my view, that might be even more attractive buy on dip opportunity, right? Again, not a stock recommendation, but some levels that I personally am comfortable with in Zomato. It might come down to 140 level. I don't think so. That's the maximum fall that we saw during the election day crash, 140 level. I don't think it's likely to go at that level. But again, I've given you some details on Swiggy versus Zomato video. That's the video you need to go watch. This stock is in my watch list until Swiggy get listed. I do not know whether I'll change my courses, whether I would like to buy both the stocks. None of these is not likely to be the case, right? At least one of them I would like to hold in my portfolio depending on the listing price of Swiggy, right? So I've given you a lot of details in this video. 5 stocks. Have kept the commentary really short so that you understand the gist of the stocks, and you can do some more research at your end as well. And if you like this video, hit the like button. With that, I'll see you in my next video. Until then, keep rocking.